Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Vessi Kapoulian. Vessi is the owner of DBA Capital Group and has over 14 years of commercial lending experience and 4 years of business management, sales, and marketing experience. Vessi started her real estate journey in 2017, and today she controls a portfolio of properties in Florida, Tennessee, and Georgia, totaling 161 doors spread over 6 properties. Vessi, welcome to the show.
Thank you so much for having me as a guest, Tim. It's a pleasure to be here today.
Yeah, and it's definitely great to have you. So, I gave everyone a high level overview of your background, but on this show, we really like to get into the details of how you got started on your journey to multifamily investing. So, please talk a little bit more about that.
Of course, happy to share that. And actually, one could argue that the seed of real estate was planted in me a while ago, back behind the Iron Curtain, where I grew up in Bulgaria many years ago. Because at the time, there wasn't really a developed stock market. So, very often when people talked about investments, they talked about hard assets like real estate, precious metals like gold and silver and such. So the idea of investment, connecting that with real estate was there, but that seed didn't quite germinate 17. So like most people, I follow the traditional path of going to school, joining a firm or a corporation and climbing that corporate ladder. And so it wasn't until 2017 that I decided to take action and purchase an investment property. For me, that was out of state. I'm based in Los Angeles, California, and really was looking for a market that's more affordable, produces cash flow, and that's more friendly. And that's what pushed me out of state. And my purpose at the time was really to create a small retirement nest egg and diversify away from the stock. So I made that very first investment and it worked well, which then prompted me to proceed with buying another residential property and then another. And that's where I think the light bulb went on. And I asked myself, how do I scale this further and can I make something bigger out of it? And naturally, the idea of transitioning to commercial real estate and specifically multifamily emerged, mostly because I could leverage a lot of the experience I had gained on the residential side and leveraging my professional experience as a commercial lender, project management experience. There was just a lot of skill set and knowledge that I could apply and make that transition. I invested once I made that decision, I invested a lot of time in getting myself educated, meeting with people, connecting with people, and ultimately completed that transition by purchasing a couple of properties. One was a JV and the other one was a syndication. And I look forward to continuing that journey. Like most people, I also invest passively. So I like to have those three income streams, if you will, the residential, the multifamily, and then the passive investment. And that's in a nutshell where I was, where I'm at today, and where I'm.
So, let me ask you, you talked about those 3 different streams of income. Now, do you still own your residential properties?
I still do. Yes, I have not sold those. They're cash flowing well, and those I own 100%. Unlike the multifamily properties where I'm not the sole owner, there are other partners involved, and that's for a variety of reasons, which we can dive into. But the short answer is yes, I still own them.
Wow, that's interesting because a lot of folks who make that switch kind of cast it off and go all in. But I certainly see the appeal of holding on to those smaller, either single family or small multifamily assets. I've held some of those myself. And, much like you, when I started out, I was living in a very expensive market. For you, it was LA. For me, it was Washington, D.C.
Mhm.
And, I went into it wanting to get a small multifamily right off the bat. Right. So I didn't want a single family because I just felt the risk was too high if you don't have a renter. I saw the value of scale, not the same kind of scale that we're used to looking at now, but even back then, if you have a duplex, right? If one side is empty and the other side is rented, at least you're getting 50%, which is better than zero if you have a single family home with no tenants. Yeah, and it just hedges your risk a little bit because but at the same time, an expensive market is still an expensive market. So when I was in DC, there was no way I'd be able to afford especially a duplex in that area. When homes were
Mhm.
going, 300, 400,000, getting a duplex just seemed completely out of the realm of the possibility. So I went to Richmond, Virginia and wound up buying a small duplex there. But unlike you, I decided at a certain point, probably because I was self managing later, which brings its own set of headaches, I decided to just go ahead and sell a triplex that I had and put that money into my burgeoning syndication business. But I think the biggest consideration there is property management, right? So have you been able to
Right.
find what you believe is good, competent property management for those residential units?
I have been, and probably that's what's also influenced my experience or shaped my experience, and also the decision to keep those properties. So, for the first, some of my properties are in Tennessee and some are in Florida. So, the very first one I got actually through a turnkey provider that ultimately exited the market. So, I had to change property managers. And that experience, it definitely took some time in the beginning to transition, but now that we have a rhythm, understanding each other's communications, work methodologies, everything's working out. And all I ask for is that the rent is collected on time, that the property is maintained, tenants are taken care of, and that there is transparency in the reporting and communication. So that has been addressed. And similarly, when I decided to further expand the portfolio into Florida, I did a lot of diligence around property managers, talking to a lot of people, asking a lot of questions. And through those conversations, you can quickly establish if there will be a fit or not. Thankfully, I was very close to signing up with one property manager at the time. And through those conversations, realized it's not going to be a fit. They were very much hands off. I'm not a hands off investor. I like being involved and make sure those properties perform because they're kind of like a business. So it was we established pretty quickly from the beginning that's not to be a bit. And thankfully, again, that happened prior to closing on the property. So now the experience has been good, but it does take a lot of research and frankly some trial and error. Oftentimes you get into a contract with a property manager and they may say all the right things or all the things you'd like to hear. And then once they actually start working or once you start working together, maybe it's not what you exactly expected or things may have been miscommunicated. So unfortunately, sometimes you learn through trial and error, but that's the nature of the business and comes with the territory.
Yeah, absolutely. I had to fire one property manager because he just refused to accept technology. And, it's like we can't be doing things on paper and stuff like this. And tried to tell him that, and you try to like nudge them in the right direction. They're stuck in their ways, then they're not going to change just for you. So you have to say, okay, thanks, but no thanks, and move on because it has to be a good fit. Like you talked about some of the reasons that you got started in real estate, and that was one, to build a nest egg, and two, to diversify your holdings. And I think what I find surprising is that so many people don't think about those things. I mean, the nest egg, sure, but they figure if they have that 401k, Social Security waiting for them one day, if it's going to be there, then they're pretty secure in that. And maybe they have like, a Roth as well, but they view diversification as having different stocks or having stocks and bonds and not really ever looking outside that bubble. Why do you think that is? And have you had to have those conversations with potential investors to kind of open their eyes to one, the risk of that perspective, and two, the opportunity in something like real estate?
I think that's a great question. And I can even speak to my own experience. One regret I have is not starting sooner. Why did I not really start sooner? Is because I didn't really think of real estate as a great investment vehicle and really an income stream that could potentially even replace your two jobs if you choose to do that. Not everyone does, of course. And so a lot of it comes with the education. I don't think there is enough information out there. And really, I think the system is set up in a way where you're trained, right, to go to school and be a good employee. Then you're presented with the path issue of getting your home, saving up for retirement, building that 401k or Roth IRA next egg. And that's the path of success that's needed for a lot of people. And but there are other alternatives out there. I really don't know why they're not spoken about as wildly. And so a lot of people you may hear stumble across real estate, whether it's through hacking or accidental landlords, as they would say. And again, even in my case, it started really because I had that idea from when I was younger back home that this is just prudent investment to do. And that's kind of what prompted me to take that first step. But I didn't know it could be something bigger. The clues were there along the way. I didn't see them when Enron collapsed, and a lot of people who were planning to retire at that time were effectively left with nothing and having to extend retirement, or hopefully they had other means of liquidity, right, to survive. The clues are there, even in today's market with the volatility, it's there. And again, I'm not planning to retire anytime soon, but God forbid that wasn't my plan for last year. I would have had a very rude awakening, like probably many people did. So I think the key is to talk about it, be open about it, and not quite why that's not really ingrained in the educational system. I think it should, but just like for many people, my path is probably not that different as far as discovering the power of real estate happened gradually over time and as such.
Yeah, and I think what you talked about, anyone who's familiar with like Robert Kiyosaki and Rich Dad Poor Dad will recognize that you must do this, then do that, and then because society expects that, and that's what's been ingrained to us. And he refers to it as the rat race, right? And some people every once in a while will veer off that path and get their way out of the rat race. But you're right, it's for most people they just stay on that straight line, and that's exactly how I was raised too, right? Just to go to college so you can get a better job than I had, and make some money, make enough to retire, and then that's it. But it's rarely that simple. So, all right. So I at the top of the show, I mentioned the name of your company, DBA Capital Group, but I didn't mention what DBA stands for. Can you talk a little bit about that?
That's a great question, and thank you for asking. DBA, it stands for Dream, Believe, Achieve. And these are really our values. Dream, because it all starts with dreams and goals, having clarity of goals, setting goals. Believe is believing in yourself, knowing that making those dreams a reality is possible, and surrounding yourself with like minded individuals will encourage you along the way. And achieve, because none of it matters if you don't take action. And as scary as it may seem sometime, all you need to do is take that first step. If you're buying a property, think about what is that first step I need to take to accomplish that. Is it reading a book? Is it talking to someone? And it doesn't have to be a big step. It could be a small step, but then taking those daily, consistent, and persistent actions add up over time and bring you closer to making those dreams a reality.
Yeah, so true. And I mean, I think a lot of us are victims of that last one, right? The action. I know I was myself when I first got interested in real estate and started listening to Bigger Pockets podcast and started reading books. And I was like, okay, I'm definitely going to get a property, definitely going to get a property. And yeah, I just kept educating myself more, reading more books, listening to more podcasts. And it's like, I sometimes felt if I just listened to that next podcast or read that next book, then I would have just enough information to take action. It's never enough. And so you have to realize that at some point and just say like, okay, I got to do it. Like, and I think you're right that laying out a plan makes that a lot easier. So if you say, first I will do this, then do that, save up the money for a down payment, then this will be my criteria for the first property that I want to get, minimum cash flow, whatever it might be. And then say, once I find that property, no excuses, I need to put an offer in, right? And that's the first step. And then if you actually
Right.
get the property, it's almost like it's nerve wracking the first time, because especially if you're having to put 20, 25% down because it's an investment property. But still,
Mhm.
at the same time, a huge
Mhm.
weight is lifted off your shoulder because you've actually taken that first step. You've done something.
Absolutely. And I think what really pushes you for a lot of people, it's emotional as well, right? You need to have that burning desire, that why that drives you. That's very important as you set these goals. Why are you doing what you're doing today? Why do you want to do what you want to do? What is driving you? And the burning desire, the why, will pull you because those do exist in the business, and it will propel you further when things are going and growing well.
You're right. Because if you don't have that burning desire, then it won't get you past complacency either. Right. Like
Mm.
there's a
Right.
lot of us who have a decent job and we're comfortable enough that, we can pay our bills, maybe go out to eat, once or twice a week. But you have to want more than that if you're willing to take those risks. And so if you don't have that burning why that kind of pushes you forward instead of lets you relax, then you're going to stay in the same place. And yeah, you may be okay, but you won't be exceptional for sure.
Right.
You'll be like everyone else.
Right. Right.
All right. Awesome conversation. Another thing I want to talk to you about is specifically your background. So, you talked about being in lending, and that is a very hot topic right now, just because I don't want to say confusion, but just so much going on with rates. And we've seen them go up and up, much to our chagrin, especially those of us with bridge debt that had floating rate loans. So, talk to me a little bit about what you're seeing in the current lending environment. I'm not asking you to look into your crystal ball, but do you expect rates will continue to climb as the Fed keeps trying to stamp down inflation? Or do you think we've hit a plateau? Or do you even think that rates are going to go down anytime soon?
I don't think they will go down anytime soon. Again, this is my humble personal view. Fed has been pretty clear that their priority is to tame inflation, which remains high. And we have seen some relief over the past couple of months, but a lot of that has been driven by the reduction in gasoline prices and transportation costs. The biggest unknown I think out there is China as well. Now that the COVID restrictions have lifted, I think that has the potential to prolong the inflationary pressure when it comes to goods and services. And then the other component of inflation is, of course, shelter and housing. Now we have seen some moderation, right, in rent growth, and in some markets, even rent declines. So I think over a period of time, that will also effectively put pressure or reduce those readings. But coming back to what I mentioned in the beginning, I think the Fed was pretty clear they want inflation to reduce. And so they will be more hawkish until that occurs, and probably won't start reducing rate immediately. They will want to ensure that we've hit a more stable level before they change that approach. So my personal view is that we'll probably have another rate hike or two, first and second quarter of this year. At that point, probably rates will stabilize if inflation is tamed down, and maybe start reducing rates towards the end of the year, beginning of 2024. So on a year-over-year basis, we probably won't see any reduction. In the long run, we will, and the 10-year curve T-bill shows that. But unfortunately, we'll probably have to go through some pain because, again, the other components of inflation that I mentioned are goods and services. And that means and a big component of that is wages. And that means that there will likely be a lot of pain for a lot of people. And yes, we started to see some of those layoffs. There's usually a lagging factor until those layoffs, the unemployment show up in the numbers, even with goods and services. And the typical trade cycle is anywhere from 90 to 180 days. So there is a lagging component of it, and we're not seeing that reduction yet. I think it will come, but it will take some time. And again, all of that assumes no major geopolitical events pop up. It doesn't decide to make decisions about gasoline prices and all that. So assuming all else equal and no other exogenous events, I think we'll eventually get there, but it will take some time, probably a year or two. And even then, I don't know if we'll get back to that 3% rate environment. I think that's very unlikely. So I'll definitely plan underwrite accordingly.
Yeah, and I think what's so important about everything that you just talked about there is that it's not simple. It's not straightforward. I think especially within the news and, politicians, etc., they like to simplify this down, inflation, to being like one simple thing, and it is not. There are so many contributing factors affecting inflation that yeah, it's hard because you have to think about stuff, but you have to take these things into account. And you just broke down, a few of them. You have CPI, which is just one measure, but there's even so many things involved in that. And then you have external factors, obviously Russia, Ukraine. If there
Mhm.
was to be a cessation in hostilities there, that may have a huge impact towards the positive. But on the China side, if they've stopped zero COVID policy, but they also have a very low vaccination rate. So if a bunch of people get sick and call in for work, that's a lot of factories shut down that provide us stuff. So what is that going to do? It's going to raise prices of the stuff that we have here, again pushing up inflation for the goods that you talked about. So just so many aspects that we need to think about and really need to look at it with an eye on the details and not just take these super high level numbers and say it will go up, it will go down. There's so many unknowns, but there are things that we can look at for clues as to which direction it's going to go in. So, yeah, I absolutely agree that probably the next year might be a little painful. We probably won't see rates go down, but the only positive news is that while inflation isn't going down, it's increasing less fast, if that makes sense. It's not increasing at the same speed that it has been. So that's an early sign that the Fed's efforts, may be helping the situation. But again, we have a long way to go from 6 point something inflation, which it's at right now, to the Fed's goal of 2%. That's still a big delta there. So he's probably going to keep pushing it, stepping on the brakes, as it were.
I agree. I agree. And it's important, like I said, to know the details and be your own, if you will, student of economics and read between the lines, but also formulate your own view. Because if you recall, not too long ago, right, the Fed was calling this transitory, and then the messaging changed to soft landing, and then the messaging changed to hard landing and recession. So sometimes I ask myself, why did I not see that coming when you print, what is it, 40% of the money supply in 6 months? We all, I guess, should have known that was bound to happen, but we learn, right? We learn from experience. We learn as we go through this. So take away those lessons and apply them going forward so you can navigate through those environments. Don't be scared, but know the facts, know the data, and know how to navigate through those markets.
Yeah, and pay attention to the words, right? Because if I say transitory, what technically means is it won't last forever, which
Right.
has to be true. And, nothing is going to last forever. So is he
Yeah.
wrong? Not
No, no.
necessarily, but people make their own assumptions, right?
Right.
On
Right.
time. No, that's great. So going back to what we were discussing earlier, you talked about getting your start in the residential and then moving to that commercial multifamily side because I think you saw the scale that's possible there. And I had kind of one of those aha moments too, right? As I'm, I got a duplex and now I got a triplex. And then I do the math to see, at $200 cash flow per door, how many units do I need in order to reach financial freedom? And I was like, that's a lot more than I planned. I forget what it was, like 50 or 80 units. And I was like, I can't buy, 40
Right.
duplexes. Like it just didn't seem possible. There's the restrictions on how much you can get and all the other challenges associated. So it ceased to seem realistic to me. And that's when I got kind of introduced to the syndication side of things. And I was like, oh, this isn't exactly the same. It's a different formula. And I don't own 100% like you were talking about earlier, but it's still a way of building my.
Mhm.
So I know the first thing that I had to do to make that transition was to get over the mental block that only
Mhm.
rich people and large institutions have in apartment buildings. What were the challenges that you had in making that transition from the residential to the commercial multifamily side?
For me, it was very similar getting through the mindset and also frankly getting educated, because even though there are a lot of similarities and I talked about transferable skills, it is a whole different asset class within real estate. Underwritten differently by the lenders, takes a different skill set or additional skill to operate and manage those properties. You're effectively buying a small business. And more often than not, you partner with others. For smaller properties, you have other active operators and you form JVs. But for the larger, in most cases, you partner with passive investors as well who know, like, and trust you, and that you will multiply and improve their investment. So as such, you have fiduciary responsibility towards your partners, towards your investors. So you have to educate yourself. And that's where I started investing a ton of time and resources and educating myself, joining a mastermind, and really a community of like minded individuals. I talked about the belief component behind my company's name. And it's important to be within the right networks with the right people who have similar goals and aspirations and where you can grow together. So getting educated, making sure you are in the right communities, and then again taking action, because you can read a lot of books, you can attend a lot of courses, but at the end of the day, it's human nature. You learn most by experience. So I encourage people, take action. Of course, don't careless about it. Take calculated, thoughtful risk, and don't look for that perfect deal because you're looking to check all the boxes. I'm not saying it doesn't exist. It's maybe out there, but it may take you a while to get it. And the time in the market that you spend versus just reading and educating is critical for you to gain that experience and frankly build equity, because it takes time, right? With real estate, it's not something that happens overnight. So getting educated, getting in the right networks, and taking action, I think these are the three components that really helped me make that transition.
Yeah, can't agree more. And, in terms of that, surrounding yourself with other like minded people, that's huge because, like, before I didn't know what multifamily syndication was. Now I go onto my LinkedIn profile and I think everyone must be a multifamily syndicator because that's like all that's in my feed. So it's kind of ironic in that sense. But that just means that, I'm doing the right thing because I'm surrounding myself with like minded individuals. The one thing I wanted to ask you, you said that you've been a passive investor as well. Were you a passive investor before you went to like the GP side and did some syndications, or did you do it after?
It happened more or less around the same time as I was thinking, how do I scale? How do I make this bigger? And part of at least my personal strategy is to build those diverse and multiple income streams. And so, for at least for me, for my passive investments, I look into other asset classes outside of multifamily. So that's a way to introduce some diversification to my real estate portfolio. Indoor markets that I'm not actively investing in, again, with the goal of finding diversification. So it happened more or less around the same time as I was making that transition multifamily, learning about syndications, benefits of passive investing.
Yeah, that's so smart. And I do the same thing. I have a solo 401k. And since I can't invest in my own deals anyways, I seek other assets that I'm not currently invested in. And I think that's one of the beautiful things about real estate as a larger asset class is you can have so much diversification even within real estate, whether it's, you know, mobile homes or multifamily or warehouse or whatever. So there's that broad set of diversification. But then even within something like multifamily itself, you can have diversification based on class of building. So A class, top of the line, brand new. That's very, and then you got B class, C class, etc. And so that's one of the things I did. I said, I'm on the GP side, it's mostly in B and C class. So let me put my IRA in or 401k into something that's a little safer, but still getting a much better return than what I could elsewhere without the volatility of the stock market. So, and then, like you said, then you have geographic diversification. It's in a market that I don't play in. So I'm diversifying myself that way as well. So, hey, this has been some amazing conversation, but we do need to move on to the turbo round. So, I am going to ask you three questions that I ask all my guests on the show, and I just ask that you give me a quick and honest. The first question: what is one red flag every investor should look out for? And that can be either a passive or active investor.
I would say probably guaranteed returns. And we will, especially if once you make the decision, right, to start investing in commercial real estate, and when you start getting on these lists and getting beware, nobody is perfect. These are all projected returns. A lot of things could go wrong. Just like any investment, it's not risk-free, right? The only way to avoid risk is not take one. But it's important to understand how the operator is mitigating those risks, what is their action plan to navigate through those, and understand the assumption behind those returns that are being presented to you, but they're guaranteed. So you are taking risks, but of course there are a lot of rewards behind it. So just be thoughtful and ask those right questions upfront.
Absolutely. And I would just say if you ever see the words guaranteed in a PPM, just run away. All right. So the second question: what is a myth about this business that you would like to set straight?
It's not a get rich quick scheme. Maybe get rich slow, but it takes time. It's like a tree that you plant, it has roots, eventually it starts giving fruit, but all that takes some time. It takes years. I'm not saying it's not possible to make quick money, but those endeavors are usually one-off examples, definitely not sustainable. So it's an investment that requires patience, and especially as an operator, a lot of the media and posts are always very positive, and it's important, right, to encourage people. But just like with anything in life, ups, there are downs, and you have to show up on those hard days. You have to know your why, show up, and keep going. Again, that takes time for this tree to start bearing fruit. So just be patient, know your why, and keep moving forward, and don't give up.
Yeah, absolutely agree. And that's important, like you said, for both the investors, the passive investors, and the operators. For the passive investors, some of them, especially, when crypto was huge, everybody wanted to like double and triple their money within a matter of weeks. And you have to talk about 5 to 7 year hold times on these deals. Not everybody wants to hear it, but at the same time, they should be looking at this like a long-term wealth building endeavor, just like you said. And then on the operator side, like despite what some people may pitch you at their conventions, like you will not be driving a Lambo after your first deal as a GP. Like, again, you have 5 year, in some cases 7 or 10 year hold times. And at the end is when you get your biggest chunk of it. And a lot of people I don't think realize that going in. So that's great. All right. And the final question: what does success look like to you?
To me, that's living a life of no regrets and impacting people and the world around you in a positive way, leaving a legacy. In the grand scheme of things, life is short, right? We have a very limited time to make an impact. I don't want to look back one day and have regrets that I could have done this, should have done this, spend more time with my family and loved ones. We have today, and we can make that conscious choice today and make a difference. And how you leave a legacy, and not only with your family and loved ones, is how you help people and how you impact people every day. And that could be a small act of kindness of smiling someone and motivating them, or it could be done in a much bigger way. But having a life of no regrets and leaving a positive impact.
Yeah, that's awesome. I'm into stoicism, and one of the things they always say is memento mori, like you will die. And just to keep that in mind, not in a like macabre sense, but in the sense that you should appreciate every day that you have and view that as, an opportunity, like you said, to have a positive impact, because you could be gone. Awesome. Well, Vessi, this has been amazing. Please tell our guests how they can get a hold of you, and if you have anything else that you would like to share with them.
Happy to do that. The easiest way to get a hold of me is through my website, dbacapitalgroup.com. D as in dream, B as in belief, A as in achieve. My contact information, along with a link to my calendar. Also, a special gift to your listeners, I would like to offer a complimentary copy of my first digital book, The Busy Professional's Quick Guide to Investing in Multifamily. It hasn't yet launched, working through a few items on the back end as far as website integrations. But if they would like a copy, they can send me an email, mention that they heard about it on your podcast. And I'm happy to share that in an effort to make them more empowered and informed investors.
Yeah, and I definitely appreciate you adding that value to our listeners. So we will have all that information in the show notes. Vessi, thank you again for coming on, and I appreciate you coming on to and look forward to seeing you do big things on your journey to multifamily millions.
Thank you, Tim. I really enjoyed our conversation.
Take care.
Thanks.